The commercial real estate sector is under a lot of stress, and many analysts and investors, including myself, anticipate significant declines in values across much of the sector the coming year. However, one particular type of commercial real estate faces the largest potential crash of them all, and that's office space. Even if you do not currently invest in office space, the future of this huge asset class will have significant implications for the broader real estate market and the economy as a whole. The idea that the office market may crash makes sense on a logical level, as more people are working from home. But from a data perspective, it looks even worse. Net absorption, a crucial indicator that measures the balance of supply and demand for office space, has turned starkly negative since 2019. Tenants have given up whopping 140 million square feet in this time frame, with 25 million of that being lost in 2023 alone. So there's no sign of slowing down. In fact, evidence points to this horror show continuing. With another 67 million square feet of new supply projected to come online this year. That's the most new office space coming online since 2009. There's a huge glut of supply flooding the market. It's happening at the worst possible time when demand is declining. Demand is obviously down due to remote work. Although the total number of days worked from home has come down from pandemic highs, it's still estimated at 400% higher than pre-pandemic levels. While there does seem to be more anecdotal evidence that remote work will decline a bit more in the coming years, to me, it seems unfathomable that it will decline to anywhere near pre-pandemic levels. The second reason demand is struggling is due to broader economic climate. Most economists believe, including the Federal Reserve's own analysis, that unemployment will rise over the coming years with stagnant or declining headcounts. Few businesses are looking to increase their office space, and even for those businesses that are hiring, there are likely relative few that want to sign long, expensive leases. No matter how you look at it, companies are just using less office space. Vacancy is up to a record 13% of quarter one of 23, which was surpassing the previous peak back in 2010. Net absorption has been negative since the beginning of the pandemic and is expected to get even worse in the coming years. Subleases are available for 216 million square feet of office space, more than double pre-pandemic levels. And basically, companies are trying to get rid of their office space, and there's not sufficient demand for it. Office rents have recovered somewhat since the depths of the pandemic, but that's not expected to last. Higher vacancy rates coupled with outsized sublease availability are likely to push down rates for new tenants. So some sublease space is being offered at huge discounts, like 30 to 50% off of their direct rate. When you look at the data and consider the logical outcome of current trends, it does seem like office prices will drop beyond 15%, which I would consider a crash. Commercial assets like office space are typically valued based on the cap rate and the net operating income. With high vacancies and lower rents, NOI will almost certainly drop. This will hurt valuations on its own. With higher interest rates and high and market rate risk, cap rates are also going to rise. CoStar forecasts office cap rates to rise from about 7.2 to about 8.5% nationwide. When cap rates rise, price go down. There's a good reason to believe that private valuations will follow. Public REITs are already seeing significant price declines, and investors who see the writing on the wall have already pushed down public valuations. Meanwhile, a private valuation takes longer to correct, and often they only get repriced upon the sale. So what all does this mean for real estate investors who may or may not be interested in office space? Well, first, be extremely careful about buying office space right now. Second, real estate around central business districts could be impacted. And third, other areas of commercial real estate will likely see large declines, but probably on a much smaller scale than the office sector. Lastly, remember that this is a broad national analysis, but each region will perform differently. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. I appreciate your time and have a good day.